The nation's credit rating has just been downgraded, a move that could have ripple effects across the economy. So what does this mean for your wallet?
That impact could hit closer to home than you might think. Joining us to break it all down is Greg McBride, Chief Financial Analyst with Bankrate. Greg, good to see you. What does a U.S. credit downgrade actually mean, and why did this happen?
Well, it's a lot like we as individuals have a credit score that summarizes our creditworthiness. And if we continued to run up debt, more and more debt all the time, living beyond our means, something crazy, sooner or later that would hurt our credit score. Lenders would start to get a little bit squeamish. Well, sure enough, that's what we as a country from a fiscal standpoint have been doing. We've been living beyond our means for a long, long time, running up all kinds of debt and really no sign of getting that act together. So each of the three credit rating agencies have downgraded the U.S. from the top step down to the second highest step in terms of credit ratings, this being the third of the three agencies to do so.
Greg, let's dig a little deeper here. How could the downgrade affect interest rates for consumers on things like credit cards, mortgages, and car loans?
The short story, Andy, is that if the government's going to pay more to borrow, so are the rest of us. We're going to pay more to borrow. Now, I did mention that this is the third of the three credit rating agencies to issue a downgrade. When the first one happened back in 2011, it really rattled investors' cages. We saw interest rates move very sharply. When the second one did it a couple of years ago, we did see interest rates jump about a full percentage point in the next 90 days. Today, markets largely shrugged it off. Maybe that continues to be the case. Maybe it's not. I mean, being the third of the three rating agencies, there's not a whole lot of new information there like what we had seen when the first two agencies had done it. But again, if the government's going to pay more to borrow in the long run, then so are the rest of us, the most direct impact, of course, being on mortgage rates.
And Greg, does this downgrade signal deeper economic trouble ahead, you think, or is it more of a symbolic warning here?
Well, what it is it's a reflection of the trajectory that we're on from a fiscal standpoint, which is unsustainable. We're living beyond our means. We're adding $2 trillion in debt every year to our outstanding debt load at a time when the economy is otherwise pretty good and unemployment's at 4%. And so the rating agencies are saying, you can't continue to do this. And it does pose a risk to investors. And so as a result, they've downgraded that. So it doesn't really indicate anything about the underlying health of the economy, but if it does lead to higher interest rates, that becomes a headwind on the economy.
Last question before we let you go. What can consumers do now to protect themselves financially?
Well, this is the one thing that we can control. So do the exact opposite of what the U.S. federal government does in terms of how they manage their finances. Don't be borrowing left, right, and sideways. Don't be living beyond your means. Instead, pay down your debts. Keep an eye on your expenses, live within your means, boost your savings. You do those type of things, you're on a more stable financial foundation. You're better able to weather whatever the economy may throw at us.
Good time to sit down at the kitchen table with a pen and a piece of paper and make that budget. Greg McBride, Chief Financial Analyst with Bankrate. As always, we appreciate your time.
Thank you.
Thanks, Greg.